Listen up. What I'm about to reveal will fundamentally reshape your understanding of precious metals markets forever. Forget the noise. Silence your phone. Exit every browser tab. Because the intelligence I'm sharing today isn't guesswork or speculation. It's documented intervention from the world's second largest economy. An intervention so severe that financial watchdogs deployed emergency containment protocols. Miss the meaning behind this action, and you'll completely misinterpret the most significant warning signal precious metals have broadcast in more than 10 years. Silver sits at 85.15 per ounce right now. Gold hovers near 49.18. And before we dive deeper, grasp this fundamental truth. These aren't peak valuations. They're nowhere near intrinsic worth. These figures represent the front line, where power struggles unfold every single second. While you monitored indicators and reviewed holdings, an extraordinary event just transpired. Chinese authorities, without advance notice or explanation, froze 5 distinct commodity investment vehicles during one session. Their sole silver futures product accessible to domestic buyers was locked down for an entire day. 4 petroleum-focused instruments simultaneously halted until regulators said otherwise. This wasn't routine system maintenance. This wasn't a technical error. This was crisis management responding to what officials explicitly called catastrophic systemic exposure and imminent large-scale retail devastation. Here's what makes this moment unprecedented. It's the second emergency freeze in 8 calendar days. Whatever stabilization they believed they achieved on January 22nd clearly failed. The underlying issue roared back with such ferocity, they had no choice but to slam emergency brakes again. When Earth's second largest economy triggers emergency trading suspensions because commodity appetite has spiraled beyond regulatory control, you can't dismiss it as standard procedure. You can't wave it away as typical bureaucratic behavior. Because what's unfolding there directly mirrors escalating tension everywhere, and that tension is hunting for new release valves. I'll demonstrate precisely what those valves are, and, more critically, how to position yourself before the next detonation phase ignites. But first, if this level of zero-fluff intelligence is delivering clarity you're not finding anywhere else, smash that like button immediately so the algorithm shows this to more investors. Subscribe if you haven't yet, because February's developments will divide the prepared from the devastated. Now let's dissect exactly what occurred, because every detail exposes the full picture. On January 30th, Chinese financial regulators executed what can only be characterized as synchronized emergency lockdowns across multiple commodity investment channels. The primary target? UBS SDIC Silver Futures Fund. This isn't some obscure regional offering. This is the only publicly available instrument in all of mainland China directly investing in silver futures contracts. The only one. Consider that reality. 1.4 billion citizens essentially possess one regulated gateway for silver futures participation, and that gateway gets shuttered for 24 hours. That's not standard risk management. That's full-blown panic suppression. It escalates further. Simultaneously, 4 oil-linked listed open-ended vehicles were hit with coordinated freezes, locked until 10:30 Beijing time. The synchronization reveals everything. When authorities move on multiple instruments simultaneously across separate commodity classes, they're not addressing a small, isolated hiccup. They're containing a cascading systemic fracture. So what broke? What triggered intervention? Premiums. Specifically, the gulf between investor purchase prices for fund units versus actual underlying asset valuations. And the figures are absolutely staggering. The UBS SDIC Silver Futures instrument was transacting at a 36% premium to net asset value. Let that penetrate completely. Buyers were paying 36% above actual silver futures worth simply to gain exposure through that channel. Here's the brutal translation. Purchase shares at that premium level, and even if silver futures remain completely static, you're staring at an instant 36% deficit the second that premium normalizes. You weren't acquiring silver, you were purchasing desperation. You were buying fear of missing out at any cost. Chinese retail participants were so frantic for silver access, they willingly paid over 1/3 extra just to enter the position. They stopped asking what silver's fair value was. They only asked how fast they could get positioned before the train left the station. Regulators witnessed exactly where that trajectory led. They observed retail capital flooding in at mathematically untenable price levels. They watched the feedback mechanism form. Premium expands, participants interpret it as validation. More buyers stampede in. Premium expands further. Even more momentum followers pile on. That's the death spiral they chose to interrupt before it incinerated the entire retail investor ecosystem. Not because they oppose hard assets, not because they're attempting to assassinate the rally, but because when that premium inevitably collapses, and it always does, those losses would be catastrophic for millions who never even understood what instrument they actually owned. Now, here's the question almost zero mainstream financial analysts are asking. Why was appetite that ferocious to begin with? Why were investors willing to accept 36% premiums instead of simply exercising patience? Because the answer exposes exactly where we stand in this macro cycle. Silver has been on an absolute moonshot trajectory. Over the past 30 days alone, silver rocketed 58%. Not 5, not 15, 58%. We're discussing price action pushing toward 118, 58 per ounce at the apex, numbers that would have sounded absurd half a year ago. Gold has been scorching upward too, up 22%, approaching 5,600 per ounce. Oil shattered resistance with Brent hitting 5-month peaks above 70 per barrel. That's not randomness. That's not sector rotation games. That's a unified stampede into tangible assets propelled by accelerating forces, not cooling dynamics. First driver, monetary policy whiplash. Central banks have been jerking markets between rate cuts incoming expectations and higher for longer rhetoric. Every time traders price easier monetary conditions, the dollar weakens, real yields compress, and metals catch aggressive bids. Every time hawkish commentary resurfaces, violent reversals occur. That oscillation generates extreme volatility, and leveraged fund structures magnify it exponentially. Second driver, geopolitical flashpoints. U.S. naval assets positioning near Iranian territorial waters, friction across multiple global theaters, supply chains feeling exposed. When traders begin pricing conflict probability into energy, and when investors start hedging currency devaluation through precious metals, demand velocity surges fast enough to overwhelm standard market plumbing. Third driver, the foundational supply catastrophe. Nobody is connecting current spot prices to reality. Silver isn't merely monetary, it's industrial lifeblood. Solar installations devour it. Electric vehicle production consumes it. 5G network infrastructure demands it. The green energy transformation is silver intensive, and extraction capacity has not remotely matched consumption trajectory. When monetary appetite, safe haven demand, and industrial necessity all converge simultaneously, you don't witness orderly price discovery. You witness violent dislocations. And when that appetite funnels through one solitary channel serving 1.4 billion humans, you produce 36% premiums and emergency shutdowns. Now let me prove this isn't confined to China. The gold-silver ratio, how many silver ounces required to purchase 1 gold ounce, has compressed to its tightest level since 2011. That's not occurring because gold is collapsing. It's occurring because silver is violently catching up. And historically, that compression pattern telegraphs major regime transitions. Simultaneously, physical silver appetite has been detonating worldwide. One prominent bullion dealer documented 158% surge in 10-ounce coin sales and a 550% explosion in demand for 1 kilogram bars over identical prior periods. Google query volume for how to purchase silver and buy silver online spiked 250% recently. That's not boutique curiosity, that's mass awakening. Individuals are hunting exposure outside conventional financial architecture, and physical accumulation represents one of the clearest manifestations of that impulse. So when Chinese watchdogs shut down their exclusive silver futures channel, that appetite doesn't evaporate, it redirects. Some flow shifts into physical bullion, some migrates into Hong Kong-listed instruments, some pivots into gold, some discovers pressure points in international exchanges. This is the critical insight everyone overlooks. The suspension didn't extinguish demand, it compelled demand to discover alternate pathways. And every alternate pathway generates additional stress on global supply chains already stretched critically thin. Now let me reveal the smoking evidence that confirms the larger configuration. Normally, when markets get halted or rattled, short sellers swarm like predators smelling blood. Hedge funds pile in, algorithms trigger, borrow demand spikes, borrow costs climb. But right now, the borrow fee for SLV, the planet's largest silver exchange-traded fund, is essentially zero. Rock bottom. And millions of shares sit available to borrow, just waiting there untouched. Nobody wants them. Nobody's shorting. Do you comprehend how remarkable that is? China just activated emergency halts. The media narrative should scream the rally is finished, regulators are killing momentum, the trade is overcrowded. Yet sophisticated capital refuses to bet against it. Why? Because they're analyzing identical data we just reviewed. The 58% advance in 30 days, the physical demand explosion, the structural extraction deficit, Chinese appetite being rerouted into alternative markets. They recognize shorting silver here resembles stepping in front of a locomotive and waving a paper flag saying, "Please stop." That locomotive is global hunger for hard assets, And if you position yourself in its path, you don't profit, you get obliterated. And this reveals something else. Any weakness visible isn't organic selling. It isn't institutions distributing. It's suppression from a narrow cohort of bullion banks dumping contracts to cap price and defend dollar legitimacy, leaning on paper leverage to restrain silver and protect currency credibility. But they're isolated. The broader financial ecosystem is standing back because they understand this $85 level is not a ceiling, it's a compressed coil. In the instant that suppression loosens, arbitrage awakens, and price can gap brutally higher. Now we must address the petroleum dimension because it's interconnected with silver in ways most observers completely miss. China didn't exclusively suspend the silver instrument. They struck 4 oil-focused vehicles at the exact same moment. That coordination speaks volumes. And on the identical day those suspensions deployed, Brent crude pierced above 70 per barrel for the first time in 5 months. While U.S. naval fleets were maneuvering near Iranian coastal zones, the market was embedding geopolitical risk premium directly into energy pricing. Chinese retail chased it through oil funds identically to how they chased silver. Here's the cycle regulators attempted to break. Tensions escalate, commodities rise, retail pursues, premiums balloon, premiums destabilize, authorities intervene. But here's the truth nobody wants to articulate loudly. That intervention addresses symptoms, not root causes. Tensions persist, supply vulnerabilities persist, demand persists. Halting transactions for 60 minutes doesn't eliminate those dynamics, it merely compresses them temporarily. That's why I'm convinced the energy narrative is nowhere near concluded, and why it validates the precious metals thesis, because both are propelled by identical underlying momentum. Erosion of confidence in paper architecture and migration into tangible stores of value. Consider what petroleum and silver share. Strategic criticality, essential infrastructure dependency, exposure to disruption, and paper markets where derivative contracts massively outnumber physical delivery capability. When stress impacts those systems and demand velocity exceeds supply response capacity, participants begin questioning whether their paper claims will actually convert into physical possession when circumstances demand it. That's when premiums detonate. That's when instruments trade 36% above net asset value. That's when regulators panic. But shutting down transactions doesn't manufacture additional petroleum. It doesn't fabricate extra silver. It simply conceals the supply emergency behind regulatory curtains. And here's the next chapter. Pressure accumulates. Demand discovers alternative routes. Premiums resurface elsewhere. Hong Kong, Singapore, London, wherever capital possesses mobility. We're already witnessing it in physical premium intelligence, in gold-silver ratio compression patterns, in the refusal to initiate short positions even when headlines broadcast chaos. Sophisticated money comprehends what regulators don't want to acknowledge. You can halt trading, impose purchase restrictions, and mandate cooling intervals. But you cannot suspend the forces generating demand, and you cannot conjure physical inventory with paperwork. So when I analyze China's intervention, I don't perceive the termination of the commodity advance. I perceive confirmation the advance is potent enough to threaten systemic equilibrium. And that signals we're nowhere near peak valuations. If we approached peak, regulators wouldn't require intervention. Weak holders would distribute naturally. Premiums would normalize organically. Markets would discover balance without emergency protocols. The reality they shut down trading twice in 8 days reveals the opposite. Demand is so unrelenting that conventional mechanisms cannot absorb it. And when conventional mechanisms cannot absorb demand, demand doesn't vanish. It becomes more inventive. Now I want to confront the concern in the room, because I know some viewers are contemplating it. Yes, silver possesses momentum. Yes, fundamentals support it. Yes, China's suspension demonstrates genuine demand pressure. But markets that accelerate this intensely, this rapidly, can also reverse sharply. Identical volatility that generates 58% gains in 30 days can produce 30% drawdowns in 7 days. Certain analysts are projecting $150 silver within 90 days. That scenario might materialize, but it's also the variety of aggressive forecast that tends to surface when retail enthusiasm peaks. I'm not advocating liquidate everything. I'm not claiming the advance is finished. I'm stating understand our position. The effortless profit has been captured. The obvious positioning has been executed. What arrives next demands greater discipline, enhanced patience, and superior risk governance. If you're already positioned, this might represent a moment to prioritize downside protection rather than adding at extended valuations. If you're not positioned, this might represent an opportunity to await pullbacks instead of chasing momentum at 52-week extremes. Authentic wealth in these arenas is constructed by individuals who purchase fear and distribute into greed. And currently, substantial greed permeates silver sentiment. That doesn't terminate the bull phase. It simply means the subsequent chapter requires more sophistication than the initial. But here's what I want you to internalize about China's intervention. This isn't the conclusion of the narrative. It's the opening of a recurring pattern. When markets heat sufficiently to endanger stability, regulators intervene. They halt transactions. They impose purchase restrictions. They execute what they believe prevents retail from self-destruction. That doesn't invalidate the trend. It means the trend is formidable enough to frighten them. And formidable trends typically possess additional runway once intervention pressure subsides. History overflows with precedent. Major precious metals bull markets repeatedly experienced cooling attempts. The 1970s witnessed multiple intervention moments. The 2000s rally saw comparable behavior. Interventions created pauses, but they didn't erase foundational drivers. I'm not claiming history duplicates flawlessly. I'm stating intervention during robust bull markets is standard operating procedure. So if you're employing China's halt as justification to panic liquidate, you might be decoding the signal backwards. Let me offer you an analytical framework instead of a forecast, because frameworks preserve capital in turbulent conditions. 1. China's suspension is intelligence, not conclusion. It communicates demand exceeded the system's processing bandwidth. That demand redirects, accumulates pressure, and eventually releases. 2. Premiums are information streams. A 36% premium represents the market's screaming desperation and constraint. You don't need to trade the instrument to respect what the premium communicates. 3. Separate short-term trading from long-term accumulation. If you trade intraday, don't chase. Await corrections. Don't compensate premium for access. If you're accumulating multi-year, volatility significance diminishes. You're acquiring the decade-long proposition of debasement, industrial consumption, and hard asset revaluation. 4. Monitor the physical marketplace. When paper access experiences disruption, physical becomes more compelling. Dealer premiums are intelligence. Ascending premiums communicate the physical sphere is constricting. Descending premiums communicate supply is equalizing. And presently, the physical market is screaming warnings. Dealers are documenting demand configurations that resemble panic acquisition. 158% expansion in 1-ounce coin transactions. 550% expansion in 1 kilogram bar purchases. And this unfolds simultaneously as China blocks paper participation. That means certain capital is being forced into channels harder to manipulate. Physical metal doesn't experience trading halts. Physical metal doesn't have a fund administrator who can disable your purchase button. Physical metal is the escape mechanism. That's why observing dealer premiums matters profoundly. When premiums rise meaningfully above spot, it signals paper pricing is decoupling from physical reality. It signals individuals are compensating extra to secure actual possession. We're beginning to witness that in select markets. Not uniformly, not everywhere, but the trend is forming. And if Chinese demand continues migrating into physical channels, those premiums can expand dramatically. That creates a feedback mechanism regulators cannot interrupt. Restrict paper access. Demand migrates to physical, supply tightens, premiums expand. Premiums validate the paper is artificial narrative. More participants rush to physical. You can't regulate your pathway out of a supply crisis. You can't suspend your pathway out of demand. And you can't reverse decades of mining underinvestment while industrial consumption accelerates exponentially. 5. Monitor the gold-silver ratio closely. It's among the most dependable cycle indicators in this entire sector. It's in a powerful reversion trajectory currently, and whether it persists or reverses communicates volumes about cycle positioning. Beneath all this turbulence, here's what I believe is genuinely transpiring. This represents a stress examination of global commodity infrastructure. Geopolitical friction, monetary confusion, and structural demand expansion are pushing markets beyond their design specifications. China halting instruments is one response mechanism. Other nations may respond differently, but the underlying pressure is identical everywhere. And pressure like this tends to produce identical long-term outcomes: repricing. Paper instruments that previously felt secure begin feeling fragile. Hard assets that felt antiquated begin feeling indispensable. Fiat currencies that felt stable begin feeling experimental. Physical commodities that felt mundane begin feeling strategic. That's not a forecast for next week's sessions. That's an observation about our location in a multi-decade cycle transformation. Individuals who recognize these transformations early position for generational wealth redistribution. Individuals who dismiss it as background noise get trapped holding devalued paper claims. So here's my question for you, and I genuinely want this in the comments section. Do you interpret China's trading suspension as warning that silver escalated excessively, or as confirmation that demand is so overwhelming, even regulators cannot restrain it? There's no incorrect answer, but your interpretation reveals how you're reading this inflection point, and that shapes your strategic positioning. Drop your perspective below. And if you've been navigating this advance successfully, share what's functioning for you, because real-world tactical feedback from this community elevates everyone watching. Let me leave you with one ultimate insight. When authorities intervene forcefully, they're communicating the market has grown powerful enough to alarm them. And markets alarm authorities when something foundational has shifted irreversibly. The forces propelling precious metals appetite aren't dissipating. Debasement concerns aren't dissipating. Geopolitical uncertainty isn't dissipating. Industrial consumption isn't dissipating. Central bank gold accumulation isn't dissipating. These are multi-year macro themes, not multi-week speculative trades. And if you're positioned for the extended game, daily intervention noise becomes substantially easier to navigate. Here's one additional framework to cement this understanding. Markets move in cycles: bull phases, bear phases, consolidation ranges, breakout events. Inside those cycles, patterns emerge. Regulatory intervention is one recurring pattern, and it tends to surface at specific junctures. Early in bull markets, regulators don't care. Moves are modest, retail participation is low, zero systemic anxiety. But as the bull matures, velocity accelerates, retail floods in, leverage multiplies, regulators pay attention. They observe premiums expanding. They observe chasing behavior. They observe risk stacking dangerously. Then they decide, let it run and risk brutal capitulation, or intervene now to contain damage. China selected intervention. They witnessed a 36% premium and essentially declared, this has escalated beyond acceptable parameters. We must protect retail from self-destruction. That communicates our location. Not early stages. The effortless profit is behind us. But not terminal stages either. If we were terminal, premiums would compress organically. Sophisticated capital would short aggressively, and weak holders would distribute into strength. But that's not observable. Sophisticated money isn't shorting. Physical appetite is accelerating. The gold-silver ratio indicates silver still possesses room versus gold, and Chinese demand is already discovering alternative outlets. That's the intermediate phase of major bull markets. The phase where volatility intensifies, intervention escalates, weak holders get violently shaken out, but the primary trend remains formidable. Individuals who construct generational prosperity are those who don't panic during intermediate phases, those who separate noise from actionable intelligence, those who understand intervention doesn't mean invalidation. China's halt isn't instructing you to liquidate. It's instructing you demand is potent enough to frighten regulators. Don't confuse intervention with defeat. Don't confuse temporary suspensions with trend reversal. Don't permit short-term turbulence to steal your conviction when the long-term thesis remains structurally intact. Maxwell here, Friday, January 30th, 2026. Silver trades at 85.15, gold sits at 49.18. China just shuttered their exclusive silver futures instrument for the second time in 8 calendar days. Physical appetite is detonating worldwide. The gold-silver ratio is at compression levels we haven't observed since 2011, and sophisticated capital is refusing to short despite the chaos. If this intelligence helped you see through the noise clearly, hit that like button, subscribe to MaxVault, and share this with someone who needs to hear it. Stay sharp. Don't let intervention turbulence shake your foundational conviction, and I'll see you in the next one.